Welcome to the Supported Living Property Podcast with your host, me, Lisa Brown, the place to learn about supported living property investing. I'm delighted today to have Mark Bowen with me, who is one of my business partners and one of my friends. And I'm also delighted to say that this is episode 50 of the podcast. When I started this, I didn't really know where we were going to go with it. And it kind of started with me just having some random conversations with people into a Facebook group, people who were doing interesting stuff that I wanted to learn about. And it's been great to see it kind of progress to this level, and that you guys are also interested in it and are enjoying the conversations too from the feedback I get. So thank you everyone for listening, and we'll crack on with today's episode. So Mark, it's great to have you here today. We've been trying to get this sorted for ages, and it's really good to finally have you on the show to talk about some stuff. For those who don't know you, Mark, do you want to introduce yourself?
Yeah, absolutely. So I'm Mark Bowen. As Lisa said, I'm one of her business partners and mates, business partners in the Supported Living Gateway. How did I get to that point? I actually had a career in the city before I became a professional property investor. I started in the city when I was 16. Started in the post room at Rothschilds. Lowly place to start, but a good organisation to start in. And I spent 30 years doing all sorts of things in the city. I wrote lots of code in the 80s when it was real code, none of these tricky PCs and Macs that you have nowadays, proper computers. I spent a lot of time flying around the world, running big global projects, helping board strategy be formed and executed, doing outsourcing, mergers and acquisitions, all sorts of really interesting stuff. And then I decided on my kind of almost exactly 30-year anniversary of being in the city that I wanted to try something else. I loved my job. It was great fun, really enjoyed it. The travel was a bit of a downer, but everything else was great. But I thought, I've never done anything else. So I thought I'll try something else. And I bought a couple of houses whilst I was working, made all sorts of interesting decisions. Some would call those mistakes, but we learn from those. And I thought, you know what, I'm going to try and do this full time and give it a go, because I've never done anything else. I've worked from the age of 16 just in the city, very, very narrow experience. So I did some training. I did some kind of classic property training, and then I also went to be a site labourer for 18 months, which is a bit of a shock to lots of people.
I love that part of your story.
Because I like to know how things work, and as you know, Lisa, I love a bit of detail. I love a bit of information. I love to know exactly why is that, why do you do that, how does that work, explain that. So if I thought I'm going to be in property, and I didn't really know what that meant at the time, to be honest, but as far as I was concerned, it meant I'll have to do decorating and building walls and stuff. I need to learn how it works. So luckily, a very good friend of mine owns quite a chunky building company in Southeast London where I live, and he employed me as a very unskilled site labourer for 18 months, and I learned how to dig holes in the ground and fill them back in again with concrete. And I was very proud when I did my first block wall and put my first architrave on. Took me about half a day to do it, but
you did it, yeah.
Get it on. And then yes, professional property investor and developer, and through various kind of conversations and networking and bumping into people, you and I ended up working together in the Supported Living Gateway. We started that probably 18 months ago, if I've got that about right, I think. Beginning of lockdown, that was when it really kicked off. We decided to try and break the world record for amount of Zoom meetings held. So not managing to actually physically get together, but then since then, really, the concentration has been on the Supported Living Gateway, about growing the general knowledge of the community about the issues that there are in the provision of supported living housing, the general issues that there are around the wider social housing thing, although obviously we have quite a tight focus within the organisation. You can't ignore the wider social housing marketplace though. And yeah, that's kind of that's my life. I still do a little bit of my own property development on the side, but to be honest, I don't really have much time for that anymore. The gateway's pretty all-consuming, as I'm sure you'll attest to.
Yeah, absolutely. It absorbs every minute of our lives at the moment, I think, doesn't it, really? But and I think it's really interesting your background, because it's so different to my background, and us coming together is brilliant, because all this, as anyone who listens to me knows, I hate things like spreadsheets. That's my like most uncomfortable place in the world. Whereas that's where you live, basically, isn't it?
Absolutely, yeah.
So it works really well, and that's what we're going to talk about today. Well, not necessarily spreadsheets, but we're here to talk about finance, aren't we? And that's something, obviously, with your background, you've got really good understanding of finance. And I think some people who come into supported living and as property investors are surprised that there are issues around finance, and find that a little bit yes, shocking, really, that they're there. What are the issues in financing supported living properties?
Well, it's the kind of you have to understand, and again, you don't have to understand. The way that I approach this is that I like to understand what's the kind of root cause of this issue. So, and if you actually understand the kind of root cause of how finance works, then you'll get a better understanding of why certain events occur, why you experience certain events, and how you can maybe avoid those events that are bad for you. So you have to kind of understand, how does it start right at the beginning, and without doing a kind of, this is how the global banking system works. But it isn't,
not quite that long.
Not quite that long, but it is. But you need to start. You do need to start right at the beginning. But money that gets lent to people generally for mortgages and finance for housing, for fixed assets, that kind of things, will generally come from the market in quotes. And what happens is that either large institutions will raise amounts of money, or bonds will be issued, or whatever it may be, that will raise hundreds of millions of pounds. And that money will be raised on the understanding that it will be used for a particular purpose. It'll be used to fund residential mortgage purchases in the UK to people who have a credit rating of 600 or above, or whatever measure they want to use, for terms up to 25 years on an interest-only or repayment basis. And that chunk of money is then given to mortgage lenders, or to facilitators or brokers, whoever it may be, but access to that funding stream is then sent out to the world and is sold to you and I, and people like us who want to buy houses. That funding stream can only be used for that purpose that it was originally raised for. And if it's used for something else, the person who raised it is in a whole world of pain, because they've basically broken either listing rules or the law. Because when you say, like when you float on the stock market and you say you're going to do a thing, you have to do it. My word is my bond. You have to follow through with what you said you're going to do. So why did I bother that 3-minute explanation of how the lending world works? Well, the problem is that if you look back to the beginning again, there isn't somebody raising money in the market to say, I'm going to raise 150 million here to provide lending to property investors to buy supported living houses on a 75% loan to value that house non-working tenants on a lease for 10 years. So that funding stream in and of itself doesn't exist in the same scale that it does for residential mortgages and so on. It is there, but it's not of that same scale. And that's kind of fundamentally the problem, is there isn't the liquidity to fund what we want to do. So,
and I guess that comes down to awareness as well, doesn't it? It comes partly, I know there's other issues there which we're going to talk about, but partly it's also just that people don't realize it's needed, perhaps.
100%. And so what that means is that when you talk to a broker, you'll quite often tell them that they'll say to you, you've got a restricted market. There's only a certain number of people you can go to. And what they're saying is the same thing that I've just described in maybe a more technical terms, but it's the same thing, as there's only a certain number of people who are willing to lend on this basis because their funding stream allows them to lend on that basis. And that's kind of fundamentally the problem. So, we need to fix all of the steps in the chain. We can't just beat the brokers up. That's a pointless exercise for everybody, because they're trying their absolute best. They want you to have a deal. If they don't have people who they can introduce you to, because there's nobody there willing to lend on the basis you want to borrow, you kind of bang your head against that brick wall you've got behind you.
I mean, and that's certainly something, when we started Supported Living Gateway, one of my big picture goals was the fact that I'd struggled so much to get the finance on one of my properties. And I was just like, this is ridiculous. It's broken. We need to try and change this system. And I know it's something that you're really passionate about, isn't it, Mark? And we talk about it a lot, is how do we change this at a root level to make it better and it make the lending easier so that more people can come into this space. But there is another issue, isn't there, that there's the term vulnerable tenants, which is used a lot. Do you want to explain that?
Yeah, and I mean, you and I can compete on how big a soapbox we want to get on and shout about this. This is quite, to my mind, almost indefensible and ridiculous. So a lot of lenders that you will hear via the channels you use to get to lenders, that they're very concerned about lending to vulnerable tenants. Vulnerable tenants, what does that mean? That's another phrase that we shall gloss over. Because of the additional risk. And because of that additional risk, they'd like a higher return. That's cool. Everybody's completely fine with that. We kind of live in a capitalist society. Risk and return have to balance each other out. Absolutely. Right. So what's the additional risk of housing for tenants who have learning disability and are receiving care in their home compared to housing a mother and young child who have a job at the local office or factory, whatever it may be? What's the difference in risk to you as the lender in that basis? And this is where I kind of have a problem. A lot of people will say, oh, there's a reputational risk. There's a reputational risk. The lenders don't want to be seen to be evicting people with learning disability. And you go, oh, okay, fair enough. So they're completely cool with evicting the mother and young child and throwing them onto the street, are they? And you kind of go, yeah, do you know what? I'm going to call you out on that one. That is just rubbish. That's the marketing department has said that's a good idea to give as a reason. Yeah. And I'm afraid it's just yeah.
It just doesn't stand, does it? And as I mean, like you say, you and I talk about this a lot, and we it's a common theme in conversations we have with people on our training course as well, and explaining it. But actually, you said, there's that reputational risk. Really, is it actually discrimination? You could actually argue that there's an element of discrimination in there, isn't there? And it at some point we need to kind of bash that on the head and help people to understand that they're not higher risk. They're
not. And there's lots of things where people say, well, if you're renting it on a lease rather than an AST, there's different levels of protection. And again, that's just rubbish as well, I'm afraid. That's people who don't understand, the law, to be honest. If you, let's say I'm a bank, I lend you some money and I have a first charge, as I would have on your property that has supported living tenants in it. If you default on that mortgage and I have to take possession of the house because there's a first charge, I put you into receivership, at which point I take the possession of the house. I take not ownership, I can't remember what the legal phrase is, but I take a responsibility for the lease. I am allowed to cancel the lease. It's the law, so there's no risk. There's no risk that I can't gain vacant possession. It may take a little bit longer, but there's no risk that I can't gain vacant possession. And so that kind of risk, you go, okay, but it's not that. So it can't be that. So what is it then? And to be blunt, I've yet to get the right answer, or not the right answer, but yet to get any answer. It may be because I'm asking the wrong people. And as you know, I'm hoping to be banging on the door of some banks soon. As you can see my backdrop, this is not a picture of my house, much as I'd love it to be. I do live in London, and not all the banks are based in London, but quite a few of them are. And I'm hoping that I can start having conversations with the people who do control the strings up front, using my broker contacts maybe to get through that door, and using my contacts as well in the city to get through the door, to be able to have a conversation with people and go, what really is the problem here? What really is the additional risk that you see? And let's have a conversation about it.
Yeah, and it's exciting. I think that we might be able to have that influence, and the power of everyone coming together through the gateway shows the need for the numbers of mortgages, the amount of finance that's needed. And I think that also adds weight to your argument. If you're going to speak to someone, you've got actual evidence of the number of people who are looking for properties and properties that are needed. So that makes it really powerful, doesn't it? Yeah. I guess. Oh, sorry. I was going to say. I
was going to say absolutely. I mean, I think we, the gateway, the number of clients that we have looking to do this. We've got tens of millions of pounds worth of demand. The amount of transactions that we're looking at, that people are looking at putting through. It doesn't take much. for us to get into the tens of millions. Properties are worth a lot in this country. There's a huge opportunity for somebody to actually, if they decide to maybe listen and design a product that works well for our clients and for the community that we work in. There's a huge opportunity. Huge.
Yeah. I guess as property investors who are listening to this, what does this actually mean for them? So we've talked about this vulnerable tenants term, we've talked about the restricted lending market, but what actually does it mean to me as a property investor in the street?
What it means is that it's more difficult than your standard buy-to-let, HMO, or even commercial mortgage, to be honest. What can you do to counter that? What can you do to smooth that path? Firstly, you need to be really clear about the terms of the lease that you've got in place. So you will either have a lease with a housing provider, an RP, RSL, whichever part of the country you're in, or a housing association. And the terms of that lease, it's very important that you get that agreed as early as you possibly can in the process of obtaining your finance. There's no reason why you shouldn't start engaging an RP or an RSL as soon as you own a property. And we talk about this a lot in the Gateway, that the great thing about the way that our product works is that people don't have to wait until their building's finished and there's a shiny, lovely example of a house for somebody to move into. They can start engaging these housing professionals from the housing associations and RPs really early on, because they understand how housing works. You can start having a conversation with them. You can start getting a draft lease in place. As soon as you've got that draft lease, at that point, you really got a good understanding of what basis you'll want to be borrowing money. You get that draft lease in front of your bank manager, if one of those days still exist, relationship manager, they're probably now called. You get it in front of your broker. You get it in front of your private lending panel, if you've got a private lending panel, whoever it may be. But that lease is the absolute cornerstone of your lending request, because it'll explain to whoever's going to lend you the money, on what terms this house is going to be occupied, or these block of flats, or this HMO, and what terms they're going to be occupied, so they can understand exactly what product works well for you. It goes back to my thing about the funding streams. They can't use their funding streams that is only allowable for ASTs because it's fixed, etc. So that's number one. Number two, you need to have realistic expectations. So until such time as you and I solve all the problems of the world, unfortunately, you will be paying higher rates, and you may be having to suffer lower loan to value numbers as well. It's not actually so punitive that it makes this part of the market unachievable. I mean, that's quite basically obvious. Again, the amount of deals that we're seeing going through, and the amount of properties that I and the rest of us in the Gateway own as well. Absolutely, this is a great strategy for us. But you will be paying more than you'd pay if you were a person doing a buy-to-let. You can get sub 2%, sub 1% actually recently. Yes. Sub 1% fixed rate buy-to-lets in your own name. You can get low threes, maybe in below 3 buy-to-lets, interest only, in company borrowing. You're not going to get that necessarily on a supported living loan. You may still get in the 3s if you're looking at interest only, and if it's actually a house. If it's maybe just an HMO, then you can happily just get the same type of mortgage, because there are no supported living mortgages that yet. No one has put a mortgage yet.
Yeah, put the yes in there.
They don't exist. You have a buy-to-let mortgage, or you have an HMO mortgage, or you have a commercial mortgage. And basically, what makes it a supported living, a mortgage you can use for supported living, is the terms and conditions within it. Your standard buy-to-let mortgage will say you can only rent this house out on an AST to any working individual, or whatever else it may say, for a term of between 6 months and 3 years maximum, which means you can't put it on a lease. Similarly, HMO stuff. So you get one of those mortgages from one of the standard kind of mortgage lenders. You'll pay a little bit more because there is a restricted market and supply and demand kicks in. You pay more because there's a reduced supply. You're not going to be paying horrendous amounts. You're probably going to be, I don't know, if you're like us, if you've been in the market for a while, you've got a decent portfolio, you're probably around 4, maybe 3.5%, 4%. that kind of number, interest only. Bit more, but not a lot. Loan to value might be a bit lower. They're still going to value it as they would if it was a buy-to-let or an HMO. So don't expect to get a commercial valuation on a house because it's a house. And remember, the mortgage company, if you default, they need to sell it. They're going to sell it with vacant possession. When they sell it with vacant possession, it's still a house, or even if it's an HMO with a license, it's still actually in their terms a house. So don't expect to get a commercial valuation. And then the top end of the scale is where you are getting a commercial valuation and a commercial mortgage. It's one of the developments that we're doing, 4 flats and an office into in the Northwest. That entire freehold will get a commercial valuation on that based on the income we're going to receive, and we'll get a commercial mortgage on that entire building. We'll pay a capital and interest repayment on that. So we'll make a repayment mortgage rather than interest only. And we're probably going to be paying high 4s, maybe into low 5s. I'd hope not, but probably maybe let's say mid to high 4s we would be paying on that. So, setting your expectations is really important. If you go in and think it's going to be as easy as it was, I'll go to Precise or whoever else is the latest and greatest, or Together or whatever it may be. Think again. It's going to be a bit slower. People are going to want a bit more information. They're going to want to know that you're an experienced landlord. You're going to need to demonstrate you're an experienced landlord. Not 20 years experience, but you're going to have to at least have a couple of years, I would suggest, experience to widen that market for you. If you've got 0 experience, you might just find there's only one person willing to lend, at which point, supply and demand kicks in, the rate you've got to pay shoots up, the value drops down. So I think they're the two things. Set your expectations and get your paperwork in order. I mean, there's all the other general paperwork, but the most important thing is understanding that lease and getting that lease in front of your broker or your relationship manager or your existing lender.
That's great, Mark. Thank you. It's been really helpful and really great chatting to you as normal. All right, take care. Thanks.
All right. Cheers,
Bye.
Bye.